Hello there, welcome to The Open here on BNN Bloomberg. Here's a look at the big stories we're bringing you from our newsroom. Canadian inflation cooled less than expected last month to 2.2%. There was a faster yearly decrease in gasoline costs, and on a monthly basis, food prices fell slightly from the previous month, but they were up almost 3.5% year over year. Excluding food and energy, prices were also up year over year. Housing costs, including rents and insurance, were a major contributor to monthly price pressures. Prime Minister Mark Carney's government faces a confidence vote on its budget proposals today. The budget proposes spending increases for defense, housing, and new infrastructure. It also made headlines for running a deficit of almost $80 billion for 2025-26. To avoid a new election, the Liberals need at least 2 votes from opposition members or 4 MPs to abstain. Canada's housing market bounced back in October, with national home sales climbing 0.9% from September, according to data from the Canadian Real Estate Association. The benchmark price of a home rose 0.2% on a seasonally adjusted basis. The amount of new listings declined, however. Sales and activity and the benchmark price were both lower than a year ago. And let's have a look at the U.S. futures. Looks like we are going to get a down open for U.S. stocks today. TSX, let's see how it ended last week. Gold rallying late in the week provided support for Canadian stocks. And we also have seen fresh strength in big Canadian bank names. For example, over the past couple of weeks, names like CIBC have been hitting record highs. Let's have a look at oil, because oil prices were supported last week by news that the Ukrainians had attacked a Russian oil export port, and reports that Iran had seized a tanker near the Gulf of Hormuz, or the Strait of Hormuz, I should say. But you can see oil has slid more than 10% over the past 12 months. And let's have a look at the Canadian dollar in the wake of these Canadian inflation figures. You can see the Canadian dollar slipping. A lot of investors betting right now that the Bank of Canada will not cut interest rates again next month. If it holds off from that, that will tend to strengthen our currency. And let's have a look at Bitcoin, because Bitcoin has been a losing proposition over the past few weeks, sliding below, well, to the lowest since the spring. Now, you can see it is up a little bit today, but has dropped rapidly in the past few weeks. Canadians could be heading back to the polls for another election if the Liberals' budget is shot down in a vote today. CTV's Jeremy Sharon filed this report.
Inside the halls of power, high stakes to start the week. A crucial confidence vote in the House of Commons that could come down to the wire.
It's going to be a particularly dramatic and suspenseful day.
It could be close, like close as 2 coats of paint, real close.
Prime Minister Mark Carney's Liberal government will need help to pass its budget. 2 seats shy of the required 172 for a majority in the House of Commons, the government needs 2 opposition MPs to vote in support of their budget, or at least 4 members to abstain.
It's going to be about math, it's going to be politics, it's going to be about who wants to trigger an election. And the answer is no one really wants to trigger an election.
The Conservatives have been clear they won't support the budget, but leader Pierre Poilievre has stopped short of confirming whether all his MPs will vote.
Are you confident that all of your MPs will vote against the budget?
100% of our MPs oppose the costly Carney credit card budget.
The NDP has also signaled voting with the government isn't likely, but interim leader Don Davies has indicated his MPs could abstain.
I think they're going to have to finesse it, because if all 7 of them came in and voted against the budget, it could defeat it.
The Bloc Québécois has indicated it'll vote against, while Green Party leader Elizabeth May has said she won't support it either, but could be persuaded otherwise, which means an election is on the table, with the outcome of Monday's confidence motion still unclear.
I think a lot of people hope that doesn't happen, but it's definitely a possibility.
Now, no party has indicated an election is what they actually want, but there is concern the numbers could be so close, a simple miscalculation could send Canadians back to the polls.
As we just told you, the inflation rate cooled by less than expected last month, and that is seen as supporting that Bank of Canada inclination to hold off from a rate cut for now. Let's have a look at the latest data with Andrew Henchik, Director and Senior Economist at TD. Andrew, thank you very much indeed for joining us.
Thank you for having me.
It does look like it was a mixed performance on inflation. Excluding food and energy, for example, prices were up 2.7% from a year earlier, and that was an acceleration from 2.4%. So the inflation dragon not dead yet.
No, not quite. I mean, there was definitely a mixed bag underneath the surface. You know, the top line measure cooled to the 2.2%. Which, you know, was a good thing, you know, with grocery prices come registering a little bit cooler than last month. Gasoline prices also having an impact there. But as you said, underneath the surface, a little bit more of a mixed bag.
And what is fueling inflation right now? We know that economic growth is pretty moribund, only around 1%. The labor market, I know it's not weakening decisively, but it's not that strong. So what is providing price pressures in the economy?
Well, the Bank of Canada gave us some indication. You know, we do have this ongoing supply side disruption with regards to trade. Anytime you have one of these supply side shocks, productivity kind of gets upended a little bit and cost structures change. And then businesses have to decide, you know, how are they going to react to this? Some of those pressures manifest in terms of raising prices for end consumers. And so part of what we're seeing now and part of what they've highlighted is that, you know, we're likely to see some upside pressure on inflation from the supply side transition, and a little bit of cooling in terms of offsetting pressure coming from, you know, the downbeat domestic economy and the labor market. And so you end up in this place where inflation's not as high as it was before, but it's also not cooling, you know, the way that it would otherwise.
So it's supply side inflation as businesses adjust, not so much excessive demand from consumers.
Yeah. In broad strokes, yeah, that's exactly the case. You know, the unemployment rate is, you know, 6.9%. That's not low, and so you would expect, given those conditions, for consumer price inflation to be cooling. Unfortunately, as I said, you know, you're going through the supply side transition that does put upward pressure on costs.
We've heard a lot of commentators talk about this emerging age. Well, it's not emerging. We are in an age of inequality, higher income groups doing better, lower income groups struggling. But I guess there's not much monetary policy on the face of it can do about that.
No, you know, the overnight rate, as they like to say, is a blunt instrument. It applies to the entire economy, and you know, the distributional effects, distributional changes in terms of income and activity are kind of beyond the ability of monetary policy to have any kind of material influence on. And so, you know, our Governor Macklem said as much at his most recent press conference. You know, there's only so much monetary policy can do in this kind of environment. You know, those other questions are best left to government.
And again, on the same theme, Governor Macklem has said, I can't really do much about tariffs and the impact on the economy.
No, exactly. You know, tariffs are the trade disruption. They are the supply side shock. similar in from an economic sense in terms of the supply side disruptions that we saw, after coming out of the pandemic. Monetary policy can't do much to offset the inflationary pressure coming from those. It tends to mostly affect the demand side of the equation. And so, yeah, to a certain extent, the Bank of Canada's hands are kind of, I don't want to say tied, but they're kind of stuck in the moment. And that's part of the reason why, the policy rate now at 2.25% at the lower end of what they deem to be the neutral range. And they intend on, well, at least they signaled they intend on keeping them there, provided the economy evolves as they expect.
Just swinging just away from inflation for a minute, we're seeing the government trying to accelerate these so-called major projects, get rid of approvals. Of course, it's tricky. There's legal implications, not just bureaucracy. But could this make a big difference to the country's slow productivity growth if these projects are built faster?
Well, I mean, that's to the government's point, $1 trillion question. They're looking to catalyze $500 billion in private investment, $500 billion of their own. For the near term, these are still projects that, for the large part, take quite a bit of time to release. I mean, I guess we'll have to wait and see. They're attempting something net new that we don't have a lot of experience with, and I think we're just as interested as everyone else to see how this might play out in the coming months and years.
Would you prefer to see more high-tech related major projects? I don't know, maybe a new technological university in maritime Canada or something like that. A lot of it seems to be resource related, not really related to a tertiary economy.
Yeah, they seem to have chosen a path that does lean towards infrastructure and more traditional drivers of the economic engine. That's a strategic choice on their part. From our lens, we've written about desire to see, enhancements to the competitive environment, a review of how tax and regulatory policy is implemented writ large. Mm-hmm. We didn't see that in this budget, but to a certain degree, maybe they sense that this budget was more of a stepping stone towards things to come. I can't really speak for them, but we'll see how this plays out.
Andrew, thank you very much indeed. Andrew Henchik, Director and Senior Economist at TD. Coming up, holiday shopping will soon kick into high gear, and it appears tariffs and general economic malaise may be forcing many Canadians to tighten their belts. Welcome back, and thanks very much indeed for joining us on the Open this morning. And remember, we're going to be getting to stocks that are on the move shortly. One stock that we are watching is Alphabet, attracting an investment from Berkshire Hathaway. We'll get a roundup of stock movers shortly, but let's get back to the holiday season. We've got some big promotional shopping days, such as Black Friday and Cyber Monday just around the corner. Holiday shopping is kicking into high gear. And it appears this year trade disruptions and economic worries may be forcing many Canadians to tighten their belts. CTV's Scott Hurst filed this report.
It appears tariffs may have a whole lot of us feeling more like the Grinch this year, cutting into our holiday spirit, but also cutting into our holiday budgets. A just-released BMO survey shows 3 in 5 Canadians are planning to adjust their holiday spending plans because of tariff concerns. Here's a closer look at some of the numbers. 37% of respondents are trying to buy more gifts with a minimal impact of tariffs, including purchasing goods made in Canada. About 25% started their holiday shopping earlier to avoid potential price increases, and about 15%, however, are budgeting to spend more on gifts in anticipation of higher prices. And ultimately, at the end of the holiday season, that big price tag is often a stressful affair. Those post-holiday credit card bills can be terrifying at times. Canadians, according to the BMO survey, are planning to spend an average of just over $2,300 this holiday season. That's not just gifts. It includes travel plans and accommodation as well, plus food and drink and decorations. From big ticket items to a few smaller things here and there. It can quickly add up, and that's where the stress comes in. About half of respondents say just thinking about holiday spending causes financial stress, and just over a third say they feel pressure this time of year to keep up with other families' spending, even if they can't afford it. And on average, Canadians believe it'll take them more than 2 months to pay off those holiday bills, and about 1 in 10 are not sure when or if they'll be able to pay off those mounting totals. So holiday cheer, yes, but mixed with a whole lot of financial anxiety as Canadians are feeling the pinch of not just the overall high cost of living, but the impact of tariffs and what it might mean for their holiday spending. Scott Hurst, CTV News, Toronto.
Up next, we'll take a closer look at those inflation data and what they mean for the housing market. We'll be right back. There was something of a recovery in the housing market in October. National home sales climbed almost 1% from September. The benchmark price of a home was up 0.1% on a seasonally adjusted basis. The number of new listings declined. Let's get more from Philip Soper, CEO of Royal LePage. Philip, thanks very much indeed for joining us.
My pleasure.
The Real Estate Association reckons there is a slow recovery in place, fueled by lower borrowing costs. Would you agree with that?
Yeah, I'd say lower borrowing costs and 3 years of pent-up demand. It's been a while since the pandemic boom, and people are having babies, getting new jobs, looking for new housing, but for many of them, they have delayed making those big decisions.
The benchmark price, though, still down 3% year over year and way down from its peak of more than 2 years. Well, substantially down, let's say, from its peak of more than 2 years ago.
Yeah, and that is pulled by certain classes of properties in certain cities. Mm-hmm. For most places in the country, home prices have been treading water for, well, a few years now.
That's interesting. You're talking in particular, I guess, Toronto and Vancouver. I mean, especially for condos, for example, they've seen serious weakness.
Exactly. If you were to look at home prices in a city like Montreal or Halifax or Edmonton or moderately priced cities, home prices haven't gone very much up, but they've inched up the same way they're inching down in broad major metropolitan areas like Toronto and Vancouver. And then we have those special asset classes like the investor-friendly Toronto condo. They really got hammered under the very high inflation and high interest rates post-pandemic, and the cutback in temporary foreign workers and foreign students.
It's interesting how difficult it seems to be in places like Ontario, though, to increase the supply of housing. One problem being that a lot of the speculators who bought properties to rent them have come out of the market. Demand has collapsed around Toronto for condos, for example.
Yeah. And, speculators is a broad term, actually. Mm-hmm. There are a relatively small slice of buyers in the market who are what we call flippers. We don't like flippers. They try to buy low and sell high. Of course, they've been out of business since the pandemic because there hasn't been enough activity in the market, enough movement in prices to make a flipper's world work. But if you're speculating in terms of buying a condominium as an alternative to an RSP and holding it and becoming a landlord for a number of years, that's been a tough market. The math has been hard to make work.
And it sounds like we got, let's face it, substandard housing. In Toronto, I'm talking about tiny apartments that people don't want to live in.
Yeah, you know what we're finding selling in the condominium sector are condominiums with parking. And you think, well, don't most condominiums come with parking? Well, yeah, if you live outside of downtown Toronto or potentially Vancouver. But for a period of time over the last 15 years, that was a really popular form of condominium. And well, we're not Manhattan, and people do still work partially in the office, partially out of the work, despite back to office mandates, which means they want transportation to get out of the city when they are not, living and working downtown. So yeah, we've got a mixed problem in our biggest city.
That's interesting. Just give us that again. For example, in Toronto, I apologize to viewers who are being a bit Toronto-centric here, but condos that don't have parking are proving a tough sell?
Yes, condos that are, and those tend to be small condos too, but the real gotcha is no place to park a car, which means you're a true urbanite, and we obviously have those that don't use a car, don't need a car, never leave the downtown core, and if they do, they rent a car, share a car. But for the majority of people buying homes now, remember our biggest cohort demographically is the millennials, even bigger than the baby boomers, and they aren't kids anymore. We've got 45-year-old millennials. So they want a car and they can afford one. They just need a place to park it.
It's interesting, just finally, we know we've got slow population growth in many countries. That's why in Canada we bring in immigrants. I've seen some research suggesting that the fact people can't get a reasonably sized place to live is discouraging them from having kids.
Oh, absolutely. Urbanization is one of the major drivers of low birth rates. People who live in urban areas have access to alternatives, and people who live in non-rural areas tend to stay in school longer. I'm speaking specifically about women. They have their kids later. I think it's about 8 years over 2 generations. The first kid is now early 30s. It used to be, call it 24 years old when baby boomers were having kids. Now it's about 32. So yeah, fewer children, and a lot of that relates to where they live.
We'd better leave it there. Phil, thank you very much indeed for joining us this morning.
My pleasure.
Phil Soper, CEO at Royal LePage. Opening bells are next. And here's the opening bell action in Toronto and on Wall Street. At the NASDAQ, it's Amerisafe. They're a player in workers' compensation in hazardous industries such as sawmills. They're ringing the bell to celebrate their 20th anniversary of listing. In New York, it's Webster Bank celebrating its 90th anniversary of its founding. And at the TSX, CN Rail is doing the honors. It's time for the first 15. Thanks very much for tuning into the Open this morning. Let's check in on the equity markets, and you can see stocks under fresh pressure. Last week was choppy, and you can see shares are weakening right now. There was something of a recovery earlier in crypto markets. We saw that Bitcoin was up, and that did encourage investors. But at one point, Bitcoin had wiped out all of its 2025 gains. You can see those stocks now in the United States pointing down as we begin the first trading session of the week. Let's have a look at some stocks of interest. Barrick Mining. Reuters reckons that this company is considering a breakup into 2 divisions. The North American operation centered on Nevada. Of course, they could get a premium valuation because of the geographic safety. And then the Asian operations, Africa, and I guess the huge new proposed mine in Pakistan. would be part of that. That would be another public entity. I don't think we've had any comment, haven't seen any comment from Barrick. And then that's what Reuters is suggesting. Interesting, this comes shortly after the abrupt departure of Mark Bristow, the CEO of the company. And let's have a quick look at TransAlta. There's a deal here with the crypto player Hut 8. TransAlta is paying about $95 million to acquire some natural gas generation facilities. They're in Canada. I believe they're in Northern Ontario. I'm not sure actually where they are, sorry. They're in Ontario anyway. And the 95 million, and Hut 8 was running these in partnership with Macquarie Equipment Finance. And so TransAlta bolstering its generation portfolio there. Let's get some movers south of the border. We're joined by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities team. Jeff, happy Monday. Thanks very much for joining us. Start off with Dell, if you would.
Yeah, happy Monday to you as well, Andy. Dell this morning is the worst performing stock in the S&P 500, and HP, Hewlett-Packard, is not far behind it as number 2. The reason being, this morning, Morgan Stanley came out with a pretty substantial downgrade of both of these companies and a pretty negative view for the outlook for hardware and equipment manufacturers in that IT hardware space for the year 2026. Morgan Stanley sees 60 basis points of gross margin reduction over the course of 2026, and that is really what's weighing on the shares this morning. This stock is down sharply. It's down 6.8% as I'm at my screen right now. Hewlett-Packard not far behind. As I said, worst performing stock and second worst performing stock on the S&P 500 so far this morning. And
so this is on a projection of weaker demand, Jeff?
Yeah, it's a projection of weaker margins, and so I think there's a little bit of maybe a little bit of both sides here with maybe the demand, maybe a little bit of tariffs hitting, but the margins is what's biting. However, I should also just mention there is maybe a little bit of a battle on Wall Street over this, because shortly after Morgan Stanley came out, or in the same morning that Morgan Stanley came out with its negative view on Dell this morning, JP Morgan decided that they were going to come out with a positive catalyst watch. So at least so far today, Morgan Stanley is winning that battle with the shares down pretty sharply.
And Alphabet drawing money from Berkshire Hathaway.
That's right. Alphabet is the top, it's actually second top performing stock on the S&P 500 so far this morning. As you mentioned, Berkshire Hathaway has acquired 17.9 million shares of the owner of Google. That's a $4.9 billion stake. And what is noticeable here is that this is a stake that was built at a time when Berkshire has been trimming its overall stocks portfolio in that quarter. So it revealed in a filing on Friday that it had built up this stake. At the same time, it had actually trimmed its stake in another tech giant, Apple. And so the shares are up so far this morning, getting that Buffett effect, as Warren Buffett it now owns about, or Warren Buffett's company, pardon me, owns about 0.3% of Alphabet's shares.
And what's going on at EW Scripps?
EW Scripps Merger Monday deal. The stock is up 23% so far this morning. Worth watching it, as it's now taken an 8% stake in Sinclair. Sinclair is a company that owns, among other things, the Tennis Channel. So what you have is a television station operator buying another kind of television multimedia entertainment company. Both stocks are getting a little bit of a lift this morning. Probably worth watching. The intention here by EW Scripps is to acquire eventually all of Sinclair. And so it's a pretty sharp move so far this morning.
Consolidation in broadcasting. Thanks very much, Jeff. Really appreciate it.
Thank you.
Bloomberg's Jeff Morgan. Coming up, we will check out this week's expected earnings from NVIDIA. Stick with us. U.S. stocks wobbling at the open. This week, we'll have one big earnings report, the NVIDIA release. Let's get more from John Zechner, chairman and founder at J. Zechner Associates. John, thanks very much indeed for joining us. What do you think? Is there a smell of fear in the air over the AI stocks and whether they've gone too far?
Well, there is, Andy, and I mean, it's interesting. I mean, you're knocking out sort of two of the pegs that have kept the bullish argument going for the AI stocks for a while. The first one being the depreciation schedule. People are suddenly worried about. It was brought up last week, like this, all this equipment that's been put in, and the growth. Um, has sort of using like 6 to 8 year depreciation schedules, and what if because of obsolescence and the need to upgrade more quickly, what if the useful life is more in the 4 to 6 year period? These companies are not depreciating the assets enough at a quick enough rate, and if they're not taking enough depreciation, you're overstating your earnings. And let's face it, earnings have been one of the great sort of backstops of the growth story of technology overall. When people say, well, it's different than 2000s because the earnings are better. Well, if not if the earnings are overstated. And then the other thing is, well, people might say, okay, well, earnings don't really matter. It's cash flow that matters. Like, that's just an accounting entry, depreciation effectively. It doesn't impact cash flow. Absolutely true. But what we've noticed is, and again, a second argument is the free cash flow. The free cash flow was a great argument for these big tech companies for a year. They generate gobs and gobs of free cash flow. They were like banks. They were like, large governments or anything in terms of the cash balances they had. They could buy back stock. They could do acquisitions. But now what we're finding is they're moving into a negative free cash flow and after getting financing elsewhere, including the bond market. You saw, Meta's deal for $30 billion in bonds. Alphabet has come in. Obviously, OpenAI is doing a major raise, even though they're not a public company yet. So the second argument that they've got this great free cash flow, that's not true. So then you start to worry about, okay, when you start to monetize AI, maybe there's a bit more of a rush to monetize this AI, because if these companies are, like I say, overstating earnings, and if they're not generating free cash flow, this story better start generating some profit in a hurry. So, we get the bar set a little bit this week with NVIDIA. I don't expect to miss, Andy. I mean, these guys have knocked the ball out of the park over the last 2.5 years. I remember back in early 23 when that first quarter, I think they were expected $9 billion in revenue, and they hit almost 11. And now you're looking at $54 billion, I think, the expectation for a quarter. So we know they get the lion's share. But, we saw good earnings from some of these tech companies that did not turn into great stock performance. Look at Palantir, Microsoft, Meta. So the bar is set very high. And, can they beat that? And, what are the sales to China and how fast are they rolling over the equipment? So, you know what? Everybody's in the story. People love it. It may be a little bit overhyped, and some things coming up from the woodwork lately are a little bit reminiscent, I hate to say it, of the 2000 when you overbuilt telecom, and you had a different valuations model. Maybe it's better today, but maybe not that much better.
And apparently Peter Thiel, who knows a thing or two about tech investing, his hedge fund sold off its holdings in NVIDIA in the third quarter. It's now betting on Apple, Microsoft, and a reduced stake in Tesla. But interesting, so we get the NVIDIA numbers on Wednesday, as you know, after the close. Maybe you could put up a one-year chart. Interesting, a smart player like that backing away from NVIDIA.
Well, everyone's made a lot of money on these stocks, Andy, as you point out, and they're shifting maybe to safer bets. I mean, obviously, you saw the thing on Berkshire Hathaway taking a stake in Alphabet as well, which Alphabet, Meta stick out to me as more value-oriented plays in the sector. These guys will probably monetize AI sooner and better than anybody else because they can deliver to their clients through their apps or through their public clouds, which Google have, the benefits of AI more quickly, and they can they can sort of benefit from that and sort of monetize it more quickly. So you can see people shifting to that and away from these high flyers that have no earnings and you don't exactly know what the valuation is going to be. So we've reduced our bet overall in the sector, Andy. I mean, we're always going to be in technology. It's still a great growth sector, but right now, in terms of what we're adding in the portfolio, I'm looking more some of the beaten up areas, some of the tax loss selling candidates where I think you're creating a bit of opportunity if you've got a little bit of patience to ride these things through, because as you know, I mean, the one thing is sometimes good earnings are met with selling, but bad earnings have been absolutely decimated, and I think that's creating some opportunities out there.
One stock that you got your eye on is Northland Power. They just slashed the distribution. The stock tanked. Is that one you say shows potential?
Oh, absolutely.
NPI,
That's a classic.
sorry.
Yeah, NPI, that's a classic example of it. Yeah, trading now about 7 to 8 times forward cash flow, which is, great for renewables. I mean, renewables are out of favor, and that dividend cut, yeah, there's a lot of dividend investors out there, and that 27% sell-off or whatever it was the other day just wiped out the year's gains that had been actually a pretty good performer. But, I was on the conference call, and when you listen to what management was saying about why they missed it, it's really because, they're seeing more of opportunities available to them. I mean, there are two major projects, Halong Bay and then North Baltic, are coming along just fine. I mean, they're going to put them into production over the next year and a half or so, generating cash flow. And what they're seeing is more opportunities because, with what's going on with the U.S. administration and they're sort of way that move away from renewables. I mean, it's creating some opportunities for others with capital. But I mean, cutting a dividend is not the way to do it. And no, I've seen it a few. I mean, another name we're buying in here is Cargo Jet recently.
Okay.
Again, a bit of a disappointment on the numbers, is economically sensitive, but the stock got absolutely decimated. It usually trades at, 10 to 15 times operating cash. So now it's down to 6 to 7 times. And then I noticed the founder came in last week and he spent $1 million buying stock himself, which I always love it when I see the founder, one of the original principals in there buying stock. So things like that. I mean, you got to have a little patience. Sometimes it's hard buying the dogs like that. I mean, but maybe it's just me. I'm a marathon runner, Andy. I'm used to pain. Maybe that's it.
BCE, our parent company, you see potential there?
Another example, exactly, Andy, of that valuation. They cut the dividend. Everybody's come out of the stock. They dislike it. But look at the valuation of the tech or the telecom sector in general. I find it very attractive, and everyone's sort of poo-pooing the idea of what they're doing with Ziply and what they're doing with fiber in the U.S. I mean, BCE knows fiber well. I mean, they've done a great fiber build out in Canada, and all they're doing is levering that expertise a little bit into regions of the U.S. And I think it's a smart way to continue to grow within the telecom business. They've monetized some assets recently. They've sort of cut, obviously, cutting the dividend and improved their cash flows a little bit. And then when I look at the long-term valuations of all of these players, I think, I don't see much downside. I see a dividend yield protection a little bit, and I see some upside if investors come around to it a little. So I think sometimes you got to chase those opportunities, particularly this time of year, because in a year where you've had a strong market, and I've seen that in our client accounts, we're all, we've got a lot of capital gains this year, and people are sort of looking, okay, if I get any losses, I can crystallize or reduce those gains, reduce my tax bill next April. And they're putting extra pressure on these stocks. And I think that creates opportunities. So like BCE, Northland Power, Cargo Jet, MDA Space, ARC Resources, it's a bunch of names that I've seen have been under pressure lately that I think will relent after that. And the valuations and the stories are still good.
John, thank you very much indeed.
Andy, have a good day.
You too. John Zechner, chairman and founder of J. Zechner Associates. On Friday, on Market Call, we were joined by Jerome Haas, portfolio manager, Lightwater Partners. Always interesting. He was covering Canadian mid-cap stocks. His top ideas were Cineplex, Rockpoint Gas Storage, it just listed in Toronto, and Descartes Systems. Today on the show, it's the one and only Eric Nuttall, partner and senior portfolio manager at 9 Point Partners. He'll take your questions on energy stocks. Up next, today could be dramatic on Parliament Hill as the House of Commons gets to vote on Mark Carney's first budget. Today will be dramatic on Parliament Hill. The minority Liberal government is tabling its budget for a third and final time. Now, the odds are that the budget will probably pass, although no opposition MPs have voiced their support. Some are apparently set to abstain. If the Liberals can't muster a majority, though, Canadians will be headed to the polls in another election. We're joined now by CTV's Colton Trail. Colton, what's expected to happen? Give us a rough idea of the sequence of events.
Yeah, you're right. It's political danger. It's really just one big game of political chicken. Who's going to blink first? Because to your point, the Liberals don't have the votes. The opposition parties, they say they're not going to support this. The Conservatives and the Bloc both say they're not supporting it. Elizabeth May of the Green Party has said that it's unlikely she supports it, although she says she could be convinced if there were changes to some of the climate policies. We haven't seen those changes. So at this point, she's up in the air. The NDP largely still in question. We could see some abstentions there. But if the Liberals are going to get by this on abstentions, they need 4 MPs who are not Liberals to not vote. So where are those coming from? There's 7 MPs. There is one Conservative that we've seen not vote in any of the last 2 confidence votes. Matt Genereux, you might know that name because he was rumored to be crossing the floor. Instead, he's resigning in the spring. So there's one possible vote, but Pierre Poilievre last week said that there would be unanimous Conservative opposition to this budget vote. So really where they're finding those 4 MPs to abstain is the big question mark. And if they don't, if there's a miscalculation, the stakes couldn't be higher. We're headed right back to the polls in that case because the budget vote is a confidence vote. And so they are going to need support. It's just very unclear where it's coming from. And don't forget, on the NDP side of things, there are also a number of potential leadership candidates there. Heather McPherson is one, for example, who might not want to be seen voting in favor of a Liberal budget when she is about to contest NDP leadership. So it's not guaranteed you're going to get those abstentions from the NDP either. Liberals behind the scenes say they're confident, but they still can't point squarely to where that support is coming from. They just think that the other parties will be the ones who blink first.
And that's the way it works. So it's a financial bill like this is automatically a vote of confidence. And if you can't get it through, you got to go to the country.
That's exactly it. You have to go to the Governor General if this doesn't pass. We've seen this happen before. Joe Clark, for example, in '79, a very similar story, right? He comes in, he's elected. 6 months later, he can't get his budget passed. Pierre Trudeau comes back into power in the ensuing election. What's different there, of course, is that there was change, right? You moved from Liberals to Conservatives, back to Liberals. Here you've stuck with Liberals, but there was a sentiment of change in the last election. The challenge for all of the opposition parties is that polling-wise, none of them are particularly looking for that election. The Conservatives, maybe Pierre Poilievre wants another kick at the can, especially before a leadership review in January, but this isn't an ideal time for them. His personal popularity is still far below Mark Carney's in polling. The Liberals really would be the only party that would be itching a bit for this election because it's the possibility of a majority. The issue for them is they can't be the ones seen to have been having caused it, because whoever does force Canadians to the polls and bears the blame for that is likely going to suffer in the voting itself, because largely we've seen polling shows Canadians don't want to be going back to vote. So it's a tricky situation for all the political parties. The stakes are incredibly high. It's likely that we will be let down, that this budget is going to pass. We're going to continue in this minority government. You know, the more things change, the more they stay the same. But at this point in time, it's important to highlight the A to B, how you get there. No one has any kind of clarity or certainty on what that's going to look like.
Colton, thanks. Great roundup. Really appreciate it. Colton Prale, our colleague at CTV News. Coming up, why young Canadians are becoming victims of investment fraud. We think of investment scammers targeting seniors, but these days, young Canadians are becoming top victims of fraud. BNN Bloomberg contributor John Ehrlichman joins us with more. John is the host of Ticker Take on YouTube. John, what's going on? Why are the fraudsters managing to fleece young Canadians?
Yeah, I think it's 2 main things, Andy. It's technology, and it's also the economic realities of today. And you're right. I mean, we used to cover on BNN Bloomberg these horrible stories of a grandmother who was targeted maybe on the phone by some fraudster who would get their financial information, and away they go. These days, though, there's new evidence, and Bloomberg has a great news story on this, that we're for the first time seeing the age group between 18 and 24 fall victim to scams more frequently than older Canadians. A lot of that has to do with the amount of time that's spent living our lives online. And for younger Canadians, the active part of the internet. So that might be chat forums, different chat tools, social media, where there's a lot more interaction. But on top of that, how many stories have we talked about with youth unemployment being high in the country and Canadians who are just getting started in their financial journey struggling because things cost so much. That makes people looking for ideas online perhaps more actively, and that recipe seems to be what's causing all of this right now.
What are some of the solutions that people are putting forward?
I think, look, I have to say, I'm obviously very passionate about the subject of financial literacy. And so you would hope that we would continue to say inroads on that. If affordability is feeling further afield for young Canadians, let's, take action to work on that. In provinces like Ontario, there has been, an effort at younger school grades and in high school to push financial literacy. I think the financial services industry itself plays a role in that, because a lot of time these scammers are pretending to be, tied to some investment or financial institution that you're already associated with. So they've got to be on the hunt for it, and the regulators, of course. I would say one of the bigger groups in all of this, though, are the technology companies and the social media platforms themselves, right? They can be the ones that are using more tools that ensure that fraudsters don't get to be fraudsters. Let's face it, they actually make a lot of money because there's advertising that is, in a sense, scam advertising. Let's do away with some of that. Let's find more verification tools online. That recipe could help, but I think, again, this is a sign of the times we're living in right now.
Yeah, apparently a Facebook marketplace, young people buying and selling things, and there's a lot of scams. Send us an Interac e-transfer before we meet. Or a fake transfer to collect your banking information. So that's one big vulnerability, apparently.
I think, how could you not imagine a scenario that gets even more complicated with more and more AI tools that are available to scammers? So I think, again, if most of that fraud is taking place online on platforms that are controlled by really wealthy, powerful companies, can we ensure that there's a way to fight back? But I think the other reality here is, if young Canadians want to think about things like investing because, they can't get a job right now and they still want to meet their financial goals, that we need to embrace that. That is a great, important thing. So I think learning so that when something doesn't seem quite right, that your own alarm bells are going off, that's probably just as important.
Yes. John, thank you very much indeed. Really appreciate it. BNN Bloomberg contributor John Ehrlichman, host of Ticker Take on YouTube. Coming up, we saw weakness at the open in stocks. Big news, though, will be NVIDIA's earnings on Wednesday. We've got more ahead. Welcome to the second hour of The Open. We're just getting warmed up. Let's get to the big stories we're bringing you from our newsroom. Canadian inflation cooled less than expected last month. It was 2.2% year over year. There was a faster yearly decrease in gasoline costs. Food prices slipped slightly from the previous month, but they are up by almost 3.5% year over year. Housing costs, including rents and insurance, were also a contributor to monthly price pressures. Prime Minister Mark Carney's government faces a confidence vote on its budget today. The budget proposes spending increases for defense, housing, and infrastructure. It also made headlines for proposing a deficit of almost $80 billion for 2025-26. To avoid a new election, the Liberals need at least 2 votes from opposition members or 4 members abstaining from voting. And shares in Alphabet moving up almost 6%. Regulatory filings on Friday indicated that Warren Buffett's Berkshire Hathaway acquired almost 18 million shares in the Google parent in Q3. Buffett now has a $4.9 billion US stake in the technology conglomerate. However, the investment firm, Buffett's firm, further trimmed its holdings in Bank of America and Apple. And there's a look at the TSX, trading pretty sideways right now. We have seen a choppy November for stocks. Big traders today in Toronto include Enbridge. It's moving up. They told us last week they plan major spending south of the border to boost energy flows, and in Canada as well, both in the US and Canada. Quebec or higher. Celestica up about $10, or actually up about $10, giving up some of last week's losses. Royal Bank flat, and Constellation Software down again, down about $7. Let's have a look at the US markets, see how they're faring. And they're now mixed. They opened by slipping, but they are pointing up. Among the big traders right now, NVIDIA is actually under a little bit of pressure as we await its earnings on Wednesday. Stock down about 1%. Tesla's ahead about 2%. And Alphabet, as we just saw, jumping more than 5%. Checking in now on the oil market. And oil, look at that, completely flat. And geopolitical risk, of course, abounding right now. That attack on that Russian oil port last week, raising fears about supply, threats to supply. And let's have a look at gold. What a great year for the gold bugs it's been. And you can see gold now down a little bit, but still above that $4,000 level. And this is actually the third drop for gold, third day of declines. Expectations, Bloomberg saying, are fading for a US rate cut, and lower rates are generally seen as good for bullion prices. And finally, let's have a look at the Canadian dollar. Pretty flat. The fact that inflation dropped less than expected, discouraging those who had hoped for a rate cut next month from the Bank of Canada. All eyes are on NVIDIA this week as we await those earnings on Wednesday. Our guest says that's the number one factor moving the markets right now. Could there be a disappointment, for example, from the chip giant? We're joined by David Dietz, Chief Investment Strategist at Dietz Wealth Management Group. David, thanks very much indeed for joining us. It looks as though clouds are gathering over the AI stocks. Of course, they've had a magnificent run this year.
Yes, absolutely. But the fears are, of course, we're in some sort of an AI bubble. A number of very high-powered investors have kind of weighed in here. In fact, in some cases, taking their chips off the table. So I would cite, for example, SoftBank has sold completely its position there. Of course, we had last week the famed investor who kind of called the downturn in the mortgage crisis back almost 15 years ago, is shorting many of these AI-related stocks and so forth. And of course, we've seen, companies like Oracle's lost a third of its value since August. Meta is down almost by a fifth since it talked about how it was going to supercharge its AI efforts. There's a big degree of skepticism on Wall Street as to whether we've gone too far too fast. But of course, the biggest player of them all, as some analysts call the godfather of the AI revolution, is going to be reporting after the market closes on Wednesday. So we're going to learn a lot more about the outlook and the results.
Jeffrey Gundlach, the founder of Double Line, is on the Bloomberg Odd Lots podcast, and he says he's loading up on cash. He said people should be at 20% cash, and he says there's garbage lending to private companies in private debt, and that unhealthy valuations in the US stock market amid too much speculative froth. Now, it's just one guy, but he's been around for a while. Do you think there's a certain amount of recklessness in the market right now?
Well, yeah, I do believe there is, insofar as you start.
Not sure if David froze there. We'll try to bring him back. Okay, David, are you there? Yeah. We lost you for a second, sorry.
Yeah, so sorry. Yeah, I do believe that there is some craziness going on out there, and that's why that's reflected in some of the meme stock developments. Having said that, of course, some of that has gone away this month with ETFs reflecting those meme stocks pulling back significantly. So I think there is a degree of caution there, but I have the utmost respect to Jeff Gundlach. Obviously, he's a fixed income investor, not a stock investor, has tended to be conservative over the years, but one needs to be selective in this market going forward.
We are getting some retail earnings, including Walmart this week. What about Walmart? What is that a stock you'd be inclined to buy right now, David?
So it's a stock we would hold. Our clients hold it. I hold it. It's the premier traditional retailer out there. It's going to give us a great read on the strength of the consumer, which of course is 70% of the economy here. Having said that, the valuations are very high for a company that half of its business is simply selling groceries and so forth. What we're also going to be watching this week is a company called Target, which is, let's say, a mini Walmart, appealing more towards the middle level consumer. But this is a stock where they're in a leadership transition. The stock is down almost half from its all-time high. Wow. It does have over a 5% dividend, and they are a dividend aristocrat, meaning they have hiked that dividend for more than 25 years in a row. So they take returning money to shareholders and making a profit very seriously over at Target, 12 times earnings. So I think there is a company where if you have some upbeat, a more upbeat assessment than others do in terms of the Christmas selling season, could reward investors for the rest of the year.
Oh, it sure is down. You have some stock ideas for us. Fiserv, they provide a platform that lets businesses accept payments and drive sales, or a financial tech company. You like the look of this one?
Absolutely, Andy. So it's basically a quintessential fintech stock, serving as the financial backbone for all sorts of transactions like credit cards and so forth. The stock was as high as $238 a share in the spring. It slid all the way down to about $62 a share because they had the triple miss in the last quarterly earnings report. They missed on revenue, they missed on earnings, and they disappointed in terms of the forecast. Having said that, they have a new CEO there, and my experience is sometimes new CEOs want to kind of set the bar low going forward so that they can do well as they get back on, as they get on their horse here. They are forecasting, even the new CEO, to earn over $8 a share in the next 12 months on a $62 stock. We can all do the math. That's well under 10 times earnings. I think they can do it. I think they can do more. So I think here's something that's a quintessential key component in the financial backbone, which has now given investors an early Christmas gift down by about 2/3. I think is a very interesting idea going forward here in the next 12 months.
Pfizer, they, of course, have been on this quest to try to get their own diabetes/weight loss drug. You see potential here?
Yeah, absolutely. So, Mr. Boris, who's in charge of the company, quintessential key CEO, the stock is now yielding close to 7%. It's got its fingers all over the globe. It's one of the top pharmaceutical makers and pharmaceutical vendors and so forth. They've just made a very key acquisition that will give them a better leg up in terms of this weight loss drug business, which by all accounts will be very big. There's some criticism that they've overpaid. I have the confidence that they can get the synergies out of that to become a key player in what's going to be a very burgeoning market. Of course, that's not all they have. They have all sorts of anti-cancer drugs and so forth that they got through their acquisition of Seagen. So it's a blockbuster of a company with a great dividend. I'm betting on Pfizer going forward.
And then finally, you've got a bit of a contrarian call here, United Healthcare. You think that the concerns over, for example, soaring medical costs are overblown, perhaps?
Well, so, we can't get rid of United Healthcare. We can't get rid of health insurance.
Right.
They're the biggest on the block. Indeed, they just got a 4-star rating, which is going to allow them to get some bonuses for the services they provide for secondary medical coverage for those who have Medicare, for example. So here's a stock that's down by about 1/3 from its all-time high. I think peak earnings could make this company trading about 12, 14 times too cheap. I think that stock price will go up. They've also had some other issues. One of their top executives, unfortunately, was killed. They've had some leadership turnover. But at the end of the day, It is the key player in the health insurance business in the United States, and one does not easily change the system or change their provider. I think ultimately there will be a re-rating in the stock. And again, we alluded to what Mr. Buffett did with Alphabet the other day. He's also built up a position in United Healthcare over the summer, so that's a good omen as well.
We should we're not going to show the Fiserv chart again, David, because we had a problem at our end with the chart. Now, Fiserv had a sell-off lately. Apparently, there's been management overhaul, etc. But you feel this company has staying power?
Absolutely. It's down by 2/3. So I think that the risk that was perceived because they missed earnings forecast and missed on guidance is very well discounted in the stock price now. And even what they say they think they can achieve over the next 12 months under the new CEO makes this stock a virtual bargain on a valuation basis.
Thanks very much. And our apologies, we had a technical glitch with the chart. David, always great hearing from you. Have a wonderful week.
Thank you. You too.
David Dietz, Chief Investment Strategist at Dietz Wealth Management Group. Okay, so Fiserv trading at just over $63 today. Coming up, we are going to get fresh perspective on the Prime Minister's keenness on major infrastructure projects and the implications for economic growth. Our guest warns that we can't just be mollycoddling a few favorite projects. We need to have smoother reviews of these things across the board. We'll be right back. We have this much ballyhooed major projects office that's supposed to smooth the path, maybe even help with financing for infrastructure projects, including mines and electric transmission lines. Our guest has some concerns, though, about this approach. We're joined by Candice Lang, CEO of the Canadian Chamber of Commerce. Candice, thank you very much indeed for joining us.
Thanks for having me.
You wrote an intriguing op-ed for the Globe and Mail, and you said, sure, this is all very well, but we can't just have a few favorites here. We need smoother reviews and quicker reviews across the board.
Absolutely. And I think just to first reflect on the backdrop behind what we have as a government's ambitious plan, which is very fitting. But that plan expects high returns on both federal investment and is expecting to catalyze private investment. So with respect to major projects, it still leaves massive holes that we have to be thinking about and addressing with bold action and urgency. But first, Andrew, let me be clear that the Canadian Chamber of Commerce and the business community, as you indicated, are in support of the Major Projects Office. But the second point here, which is very important, in no way can we lose sight of the fact why we have the Major Projects Office. We have it because we have a problem with the maze and mess of our regulatory and red tape environment that we need to be prioritizing and addressing in parallel so that we can have an overall business environment that attracts and retains capital, especially given the current context that we have with this urgent need to shore up our economic security.
And in a way, it is a bit Kafkaesque. We're going to set up a bureaucracy to deal with bureaucracy.
Well, and it doesn't send the right signal to investors as much as the signal of, we're also in parallel going to be fixing that environment and overall business environment that can attract and retain capital.
It's a tricky one, isn't it? Because we've had this huge infrastructure of approvals and I guess law firms and consulting firms that make a pretty good living out of producing expensive reports pro and con these projects. So there's vested interest in keeping the delays going.
Yes, but there's also a significant economic imperative to be able to support more than 11 projects. And there are projects that we're worried about, smaller, more regional projects, but all the projects that are left, on the sidelines. And overall, our read, just in terms of how urgent and important this is that the Major Projects Office doesn't equate to overall business confidence. And our business data lab, Andrew, shows that, 5 quarters of decline in business confidence, which means we have so many businesses that are still cautious and hesitant to commit to costly capital investments. So the fear is if we don't address in parallel that overall environment and are really bold and ambitious about it, we will have firms holding on to capital. It could be 3 years from now and that capital's not deployed. Or worse than that, the hole in our boat gets worse and that capital is flowing to other markets and not right here at home. And we can actually track that outflow quarter by quarter. And that's the concern, is that we're not sending the strong and bold enough signals to have that capital deployed here at home.
I guess you could understand it if you're a big Asian or European country. You might look at Canada and think, ooh, they're vulnerable to Trump's tariffs.
Yes, that's why there's a lot at stake, and we want to be able to, send strong signals. And I think how we do that is, and the U.S. I'm glad you brought that up, because in the context of the United States taking on major reforms in taxation and the regulatory system, we need to actually look at that very carefully with that lens on our own systems to make sure we're competitive, and that we do that, I guess, force field analysis. So the headwinds of the regulatory and red tape burdens aren't in the way. And then on the other side of the equation, we also have the right incentives when it comes to taxation. And it's so important to do that analysis at this point in time, because our plan that the government is putting forward is banking on, and our future, we're betting on an investment surge.
And yeah, obviously, that's the other side of the coin. The government says, the finance minister, Mr. Champagne, says, well, this is going to release hundreds of millions of private sector spending. One thing, sorry, can we just loop back to taxation for a second? Business leaders, and I think, I'm not sure if it includes you guys, but I know a lot of business leaders have said, look, one way we should maybe be thinking about taxes, increasing sales tax, a consumption tax, and cutting back on income taxes as an incentive. What is your position on that?
Well, we have a lot, and actually there's a lot of layers when it looks at taxation. I think when we look at what was in the budget, we look at that as a good start. When you look at things like the productivity super deduction and other changes, I think we just need to do that review, especially in the context looking south to the One Big Beautiful Bill, and actually use that as the context to decide, okay, what are all the angles here we need to be looking at when it comes to tax and incentives?
What in particular would you like to see the government do?
Well, I think in terms of the specifics, that's what we're tackling right now, is a look at that specifically and coming up with the recommendations. But like I said, the budget had some good things that are a positive start. But our position is we need to actually dig into that. And thank you, but let's go further here in the context of that review with what's happening south of the border.
Candace, thank you very much indeed.
Thanks for having me.
Candace Lang, CEO of the Canadian Chamber of Commerce. Coming up, we'll tell you why Canadians' burgeoning commercial space industry could be entering a new chapter. Let's check out a few stocks on the move right now. We did see some strength in lithium names today. The price of that battery material jumped in China after the giant producer Ganfeng Lithium said it expects lithium demand to grow by 30% by 2026. Lithium shares, of course, have been, look at that, Lithium Americas, have been in a major downdraft amid fears of oversupply. However, Ganfeng coming out with an optimistic forecast there, and Bloomberg Intelligence says that we are likely to see an improved environment for lithium next year and in 2027. And let's have a quick look at CoreWeave, because in some ways it's become a poster child for this sell-off in tech stocks. This is an artificial intelligence equipment company Bloomberg argues, well, it's more of a provider of computing services, but it plays into the whole AI build out. Bloomberg argues that it's swimming in debt, and that stock dropped 26% last week. It only went public earlier this year. The stock at one point, though, was up more than 400% from its April low. And as of today, still up around 90% from the March IPO price. And we saw some fresh pressure on Dye and Durham today. That software company is under new management, new CEO, but it has been forced to delay financial filings. Interest from the federal government marks a new and potentially lucrative chapter for Canada's burgeoning commercial space industry. CTV's Garrett Barry has more in this report.
Canada's space race, where companies like Nordspace are facing off to become the commercial hub for rocket launches and satellite deployments, is about to get a major funding injection.
It's going to be a catalyst. It's going to be an accelerant.
$60 million in cash from Ottawa is set to flow to this industry each year for the next 3 years at least, if Mark Carney's first budget passes in the House of Commons.
So to see it be called out so specifically in the Canadian budget is a huge vote of confidence, not just for companies and initiatives like ours, but for the Canadian public, that sovereignty in space is being prioritized for the first time.
Federal officials haven't said much about where this money will go, but the goal is to create a totally Canadian solution to get satellites up in the air.
Geopolitics have really changed the game for Canada in the last year or so.
U.S. President Donald Trump's musings about making Canada the 51st state seem to have boosted the desire to become self-reliant.
Canadians in a day in and day out basis need banking, and they have cell phones and global broadband and all these kinds of things that really do depend on satellites in orbit.
The players in this industry say they're ready to receive this money. Maritime Launch Services near Canso, Nova Scotia, has a launch window opening on November 18th. They'll attempt to send a Dutch rocket 100 kilometers into space on their launch pad.
The next step in the puzzle, the big gap for me, isn't really about the spaceports. It's really about the launchers themselves and whether they're ready to fly and get their payloads delivered into orbit. And that's not a small task.
Nordspace CEO Rahul Goyal says he understands the federal government wants this problem solved by 2028. Garrett Berry, CTV News, St. John's.
Okay, coming up, we're going to take another look at Alphabet shares, a purchase by Berkshire Hathaway delighting the market. Alphabet up after Berkshire Hathaway bought a stake. Let's get more from, or bought more shares. Let's get more from Bloomberg's breaking news editor, Lara Sandley. Lara, happy Monday. Thanks for joining us. Update us on Alphabet, please.
This is a pretty big stake. It's 4.9 billion shares. $4.9 billion is in total, and that's about 18 million shares in Alphabet and about 0.3% of the entire company's outstanding shares. So this is a pretty big deal because Buffett's picks tend to outperform the market, and the market watches what he does very closely. He also trimmed some of his biggest positions. He cut its Apple stake by 15%, sold some shares in Bank of America. So again, these moves are very closely watched, and these ones in particular, considering the fact that Buffett is planning to step down as CEO at year's end. So perhaps a little bit of extra interest in these most recent picks.
That's fascinating. Of course, Berkshire made that long-standing bet in in Apple. I think Buffett has said he thinks Apple is more of a consumer products company than a tech company. I guess you could debate that all day. But they have been reducing their stake in Apple.
Yeah, definitely. It's one to watch for sure. And also Bank of America is a surprising one to reduce the stake in as well. So market reacting to those two.
Yeah, as far as I know, and you can correct me if I'm wrong, it may not even be clear. This is the first time they've disclosed a stake in Alphabet. I'm not sure about whether they had much stock at all before. Tell us what's going on, please, with Johnson & Johnson and Halda Therapeutics.
So Johnson & Johnson is looking to beef up its portfolio because it's going to face a lot of competition for when it's psoriasis, Stelara. It's facing copycat rivals. So they're really aiming to rebuild their drug pipeline. And this is coming among other acquisitions. It spent big on acquisitions like Intracellular, plans to spin off its orthopedics unit. So really, they're making a move here by buying Halda Therapeutics for about $3 billion in cash. And this company develops an oral therapy for prostate cancer, along with drugs targeting other tumors. So really what we're seeing is Johnson & Johnson trying to branch out and account for what they're losing to copycat rivals. So shares going up this morning on that news.
I think one rule of business is avoid competing on price as much as you can. Try not to get into a war with your competitors. But Novo Nordisk is trying to undercut Lilly on the price of some obesity drugs for so-called cash pay patients.
It's a very interesting story. Novo Nordisk is stepping up the price war, as you mentioned, and they're cutting the cost of the blockbuster weight loss drugs to win back their market share in the United States. And this is sending, as we can see on the screen, Eli Lilly shares down because starting today, introductory doses of the drugs Wegovy and Ozempic will cost $199 a month for 2 months before the price goes up to $349 a month. And that number, the $349 number, is important because that matches the price of Eli Lilly's price. That's the same price for both of those companies. So the move is really aimed at winning back customers who have turned to cheaper options. They've been turning to telehealth firms like His and Hers that sell maybe less official versions. And this discount also comes ahead of a Trump administration pricing deal starting in, I believe, March, that will lower U.S. prices for both Novo and Lilly drugs. So both of those drug prices, we see they're decreasing and becoming maybe more accessible to the consumer, sending shares down for Lilly.
Thanks very much, Laura. Really appreciate it. Happy Monday and have a great week. I hope to talk to you again soon.
Thanks, you too.
Bloomberg's Laura Stanley. So fewer people bought homes in October compared to the previous period, despite a drop in prices. That's according to data from the Canadian Real Estate Association. Let's get more from our own Lindsay Biscaya. So what is happening in the housing market? We know that prices are down year over year.
Yeah, it's interesting. It depends what you're looking at, right? Because prices are down, as you say, year over year, but month over month, they're actually up. So it depends what you want to focus on here. We're looking, we'll start with year over year. Yeah, they are down compared to October of 2024. 42,000 homes were sold last month. So that's down 4.3% compared to October of 2024. Prices were also lower, but when you look at new listings, they were up 7.2% compared to a year earlier. But yeah, when we start to look month over month, you're seeing almost a reversal there. Home sales up just 0.9% on a monthly basis. So they're not up a lot, but they are ticking upwards. This is the 6th consecutive increase over the past 7 months. New listings, though, when we look at month over month, they were down by 1.4%. And then the price of a home was up very slightly compared to the month before.
So there are signs of life in the housing market, but it's not a huge recovery by any means.
It's not a huge recovery by any means. There is some optimism for the future, especially when we're looking at benchmark home prices, because the price of a home, as I mentioned, has gone down. So there's optimism with those lower prices that we could see more people entering the market. The benchmark price was up 0.2% month over month, down though 3% year over year. So it depends what you want to look at. I know we're speaking with Phil Soper from Royal LePage earlier today. He says it really depends on what city you're looking at as well, because obviously when you're looking at the bigger markets like Toronto or Vancouver, that differs a lot from some of the smaller markets. Here's more on what he had to say.
If you were to look at home prices in a city like Montreal or Halifax or Edmonton, or moderately priced cities, home prices haven't gone very much up, but they've inched up the same way they're inching down in broad major metropolitan areas like Toronto and Vancouver. And then we have those special asset classes like the investor-friendly Toronto condo. They really got hammered under the very high inflation and high interest rates post-pandemic, and the cutback in temporary foreign workers and foreign students.
So Phil Soper telling you that obviously people have been waiting after the pandemic. People have been kind of hesitant to get back into the housing market. But again, as I mentioned, many economists saying 2026 is looking like a better year when it comes to the housing market because of those lower prices. People are maybe hopefully getting back into the market, lower borrowing costs. And of course, we saw another rate cut last month. That was the 4th of the year, maybe the last one of the year. But it will potentially help people feel like it's a good time to start maybe looking at buying a house again.
Lindsay, thanks very much indeed. Lindsay Biscaya, our own Lindsay. Coming up, hot picks. We're going to check out. I always love this industry. 3 plays in biotech. That's ahead. Our guest covers the biotech industry, and that's the theme for Hot Picks today. We're joined by Robert Driscoll, Senior VP of Equity Research at Wedbush. I love this bit of industry jargon here. Revolution Medicines. It goes after RAS-addicted cancers, and it sounds like the poor cancers have a substance abuse problem. It's not really like that. They depend on mutations in the RAS gene, and Revolution is trying to go after that.
Yeah, good morning, everyone, and thanks for having me on. So Revolution Medicines, or we call them RevMed, so it's a targeted therapy against tumors that, as you said, are driven by mutations in a gene called RAS. About 30% of all cancers are actually driven by these mutations. Most frequently mutated gene in cancer. We've had a lot of trouble trying to drug it over the last kind of 30 years. Even 10 years ago, we still called it undruggable. Lots of companies still trying. RevMed have come up with really neat way of targeting RAS that's maybe broader, ultimately maybe more effective than these other strategies in development. Shown some really exciting data in pancreatic cancer for their lead asset. Really hard to drug disease. They're in late stage clinical trials now in the second line of pancreatic cancer. Just started late stage trials in the first line. And we think in the next few years, we're really going to have a strong franchise in this disease. Really notably, RevMed was recently one of the first recipients of the Commissioner's National Priority Vouchers. This is essentially allowing them as speedy approval, so it seems the FDA is highly supportive. And we recently saw some really compelling data in lung cancer as well. So we'll see some more data there next year. Ongoing clinical updates across the programs here. We think shares are going to continue to drive higher here. Company has about $2 billion in cash, so really building for that long term, that next stage of growth, and essentially well capitalized now into commercialization as well. So.
And so these are signaling proteins or genes, and they just go into a permanently on state, and that's the core of the problem.
Yeah, exactly. And it's they switch up between on and off, and some of the strategies have gone after the off switch, some have gone after the on switch, and we think RevMed is really the best solution of going after the on switch.
Monte Rosa Therapeutics is your next idea, and they are working with molecular glues. Can you tell us what they are, please?
Yeah, so a brand new kind of class of therapeutics here, molecular glue degraders. So instead of binding to a disease-caused protein and hoping that protein is inactivated somewhat, it actually causes it to be destroyed or removed from the cell completely. So this has a number of theoretical advantages versus traditional drugs that just bind these proteins. So it should be longer acting, potentially more effective. And then it opens up new targets for development that we haven't been able to go after before. So Monte Rosa's platform, it is fueled by AI to help design these new molecules. They currently have 3 programs in the clinic. The first is in for prostate cancer. We'll see clinical data for sometime in the next few weeks. The second program was for novel autoimmune disease that target. Recently partnered with a big pharma company called Novartis. They'll pay for those late-stage clinical development for them. And then the third program just went into the clinic for inflammatory diseases, and we'll see data for that in the first half of next year. Really excited about that. So next-generation drug development platform has been really productive, and we think it's undervalued here. Cash balance here is about $400 million as of that last quarter, and we expect that to fund operations through 2028.
And finally, a player in cancer treatment, Cura Oncology. What is their particular angle?
Yeah, so oncology-focused company, lead drug in development here for a large subset of patients with acute myeloid leukemia, or AML. So just last week, their drug called Komzifti just got approved by the FDA for patients in that late line setting. Very few options, unfortunately, for relapsed or refractory AML patients. But we think the profile of Komzifti makes it really attractive for doctors and, of course, patients. So we see a strong launch ahead that we expect to drive the stock higher. Maybe more importantly, the way the FDA kind of views this drug, we think that that profile is going to be allowed to be used in frontline settings as well. So really big market. Patients might be less sick. They might demand that their therapeutics have a safety profile that kind of matches Komzifti. So current late-stage clinical development there. We'll see some data there at the large hematology meeting in December that we can get excited about. Kura does have another targeted oncology drug in development for renal or kidney cancer. We'll see data for that in 2026. Again, hoping to drive shares higher there. Cash here is $609 million as of last quarter, and then they do have a development partner here in a Japanese pharma called Kyowa Kirin as well. So.
One of the frightening things about cancer is that it evolves within the body and develops resistance. Is that part of what Kura is trying to deal with here?
Yeah, exactly. So, a lot of the time, these targeted oncology drugs are essentially playing whack-a-mole. Kura is basically trying to end that process and then maybe turn these cancer cells into more normal cells. So that's their kind of particular strategy.
Yeah, it's incredible. And the cancer cells, of course, they cooperate with each other. They're part of us, but they're not a helpful part of us. We'd better leave it there. Thank you very much indeed, Robert.
Thank you.
Robert Driscoll, Senior VP of Equity Research at Wedbush. Coming up, we're going to tell you about a $30 billion US AI company many people haven't heard of. AI coding startup Cursor has raised $2.3 billion US in a funding round that values the company at about $29 billion. Let's get more on what this company plans to do with the cash. We got perspective from the Cursor CEO, Michael Truhl, in an interview with Bloomberg's Caroline Hyde and Ed Ludlow.
We raised this money to invest deeply in research. And we are this company that's something in between a product company and then also an AI and models company. And in parts, it's an important product lever for us to do our own investment in product-specific models. And that's something we've been doing for many years. This lets us do that in a bigger way.
It's AI coding. And, I was in Washington, D.C. for GTC DC. Jensen Huang goes on stage and he made a very pointed remark that software, generally speaking, is now worth paying for, and he used Cursor as the case study. Would you actually talk us through the case study? NVIDIA is a big company. It has many of its own engineers. How are they using Cursor? What are they using it for? And how are you charging them for it?
Well, we've been really happy to see not just the accelerating demand in our market, but also the success in our deployments with customers. There was actually a study that came out recently that showed that customers, after they switch to our agent, get 40% more done. And
this is a productivity reference for the engineer themselves, the workload that they're trying to get through.
Yes.
Okay.
It's looking at pull requests merged and metrics like that. But folks are seeing lots of success out in the field. And so to Jensen's comment, the ROI of buying the tool has been so high for many of our customers, which makes us really happy. And on the pricing front, there's two components. One is a seat component, where we look at usage, we look at how many people are using Cursor every month within an account, and then pricing matches that. And then if folks are using the product in a really, really deep way, there's also a usage component, similar to a Databricks or a Snowflake.
What's interesting is vibe coding was all the lexicon in the past few months. And many people felt that it was individuals who are paying the $20 for Cursor and really doing it and really feeling the power of understanding and being able to prompt. How about now what you call AI coding? Is this more of an enterprise play? Is it more of a sit at home and play it being a developer play?
We serve professional development teams, and in particular, professional engineers are our ICP. And so when we use the term AI coding, it's to underline that we care. There are some folks that experiment with the tool for prototypes. But the core use case, the reason the vast majority of customers are using Cursor, is to get real work done in their real jobs. And that means shipping carefully in professional code bases at the highest degree of quality.
We were just talking about all the CEOs of the Magnificent Seven and others who have been using Cursor, been talking about Cursor. They must have been calling Cursor, Michael. How many inbounds are you getting on companies wanting to buy you at this moment?
We've been really excited to see demand both across the Mag 7. 6 out of 7 of the Mag 7 actually are customers, and we're really happy about that. But then also staples of the real economy like Starbucks and PwC and Hilton and Budweiser, and then many digital natives like Stripe, Adobe, Uber, NVIDIA, Shopify, and others like that.
I'm going to jump in there, Ed, just quickly because
go for it, please. Yeah,
you're not answering exactly my question. Has anyone been trying to buy you?
I can't talk about things like that here.
You can talk about them here. Bloomberg Tech is the right place for it. What you've been doing is shopping yourself. Find that very interesting. You used M&A to address your own talent requirements, growth by design. What was behind that move, and what was the problem you were trying to solve for in doing that?
Growth by Design was a talent agency that we had worked with for a long time, and the folks that were running that business, we got to know over many months, working with them on building the team. They're respected recruiting leaders in the industry. And we started talking with them a few months ago about whether they would come in-house and join us to lead talent for us. And this is a strategy that we've taken kind of across the board, whether it be in R&D, go-to-market, G&A. We look for the best people in our industry, and sometimes, conveniently or inconveniently, they're running their own companies.
What's so interesting is how fierce the talent fight has been in many ways, Michael. Talk to us about where you are getting your talent from, how you're going to see that Growth by Design is going to bring on even more of the best people to work and build your business.
Still largely folks that join us we reach out to, and that's through knowing past colleagues of theirs, and we invite them to interview. But more and more, we're scaling that and trying to diversify how we find folks. And then we have a deep interview process where for instance, on the engineering side of things, we invite folks in for 2 whole days to spend 2 days with us going end-to-end on a project. And that's both giving them lots of information on us as a company, that also gives us really great signal about whether they're going to be a fit when they join.
You've grown incredibly quickly, and you've joined us on this program to explain how Cursor is being used in the real world and generating real revenues. But if you were to reflect honestly on what's still difficult for you and Cursor, and what some of the, I guess, barriers or headwinds are to your industry or you specifically, what are they? You know, what is it that you need to see change right now?
Well, we have a long product journey left. We're just at the very start of how we think building software and coding is going to change over the course of the next few years. And I think it can be really, really easy for folks who are removed from writing code all day to stay in touch with just how far away we are from all of software changing. And despite all of the change over the past few years, there's still so much further to go. And so in particular, we're very focused on making Cursor not just more productive for individual engineers, but now helping teams broadly and helping across the software development lifecycle.
Let's have a look at some stocks of interest in Toronto. Superior Plus, propane, compressed natural gas. Market didn't like the latest numbers, at least one downgrade for the stock last week. Rallying a little bit today. The senior accommodation stocks are popular with investors. Sienna and Extendicare both hitting their highest today in at least a year. SIA is Sienna and Extendicare, EXE. Obviously, demographics on the side of those companies. There's a quick look at Sienna. Whoa, look at it rallying there. Another big oil stock that's popular with investors right now, there's Extendicare. Suncor hitting its highest in at least a year. Investors buying into that oil sands giant under Rich Kruger, the former boss of Imperial Oil. And TC Energy, the pipeline giant, also popular with investors, hitting its highest in at least a year. Thanks very much for watching The Open. Morning Markets is coming your way.